On January 28, 2026, without a press conference or emergency announcement, something small quietly changed in global trade. Several major maritime insurers adjusted war risk clauses for vessels transiting the Strait of Hormuz. No shipping lane was closed, no tanker was hit, no military engagement was declared. Ships kept moving, oil kept flowing, containers kept crossing the water. The adjustment was modest. Just a few additional basis points in insurance premiums. Not enough to trigger headlines, not enough to cause panic, but enough for shipping companies to rewrite contracts, enough for energy traders to update risk models, enough for logistics firms to quietly recalculate delivery costs 6 to 9 months out. For most people, nothing appeared to happen. Fuel prices didn't spike overnight. Store shelves stayed full, markets barely reacted. Yet beneath the surface, the cost of moving the world's most important commodities had shifted, slightly, invisibly, and in a way that doesn't easily reverse. No explosions, no speeches, just paperwork, and almost no one noticed. At first glance, this looks like another chapter in a familiar story. Iran, nuclear tensions, military posturing, diplomatic threats. But this is not primarily a nuclear story, and it's not really a military story either. What's unfolding here is something quieter. This is about how risk enters the global economy without crossing the line into war. When tensions rise but remain ambiguous, governments hesitate. Markets don't shut down, but they don't feel safe either. And into that uncertainty steps a different actor: insurance. Insurance doesn't care about speeches or intentions. It responds to probability. Once insurers decide that something is slightly more likely to go wrong, the price of movement changes, not dramatically, persistently. That price doesn't stay in the shipping industry. It moves downstream into energy contracts, manufacturing inputs, airline costs, and eventually household expenses. This is why the real signal wasn't a missile test or a diplomatic breakdown. It was a clause buried in maritime contracts. The danger isn't escalation in the traditional sense. The danger is normalization, where higher risk becomes routine, priced in, and no longer debated. And once that happens, backing out becomes far harder than escalating ever was. To understand what's happening, we need a name for it. This phenomenon can be described as the maritime risk transmission cycle. The name matters because this is not about a single country or a single event. It's about how geopolitical tension translates into everyday economic pressure without a clear moment of crisis. Here's how the cycle works. First, tensions rise in a strategic choke point, but stay below the threshold of open war. That ambiguity is intentional. It avoids retaliation while still creating uncertainty. Second, insurers respond, not emotionally, but mechanically. They adjust premiums, exclusions, and liability terms to protect themselves. Third, companies don't stop operating. They adapt. They pass costs forward, stretch timelines, hedge exposure, and reduce risk where they can. Fourth, these small adjustments accumulate. Energy becomes slightly more expensive. Shipping becomes slightly slower. Contracts become slightly more cautious. No single change feels decisive, but together they reshape behavior. This is why the cycle is so difficult to interrupt. There's no clear enemy to confront and no dramatic event to reverse. A useful metaphor here is a toll road you didn't realize you were on. The road is still open, traffic is still moving, but every mile costs a little more than before. You don't turn around because there's nowhere else to go. And by the time you notice how expensive the journey has become, the toll booths feel permanent. The maritime risk transmission cycle doesn't require war to function. It thrives on hesitation, complexity, and plausible deniability. And once it's underway, the most powerful effects appear not at the point of conflict, but far downstream in prices, planning decisions, and long-term confidence. That's what makes it easy to miss and difficult to stop. What makes this phenomenon difficult to see is that nothing officially changes. No treaty is signed, no war is declared, no shipping lane is closed. Instead, pressure builds inside systems most people never look at. Insurance tables, shipping contracts, risk models, and quiet policy memos. Let's start with maritime insurance, because this is where geopolitics first becomes economics. Insurance firms don't respond to ideology or headlines. They respond to probability multiplied by exposure. When regional tensions rise, even without violence, insurers begin to ask a simple question: what happens if something goes wrong, and who pays? If the answer becomes less clear, premiums rise, not dramatically, incrementally, a fraction of a percent here, a new exclusion clause there, a shorter coverage window, a requirement for additional documentation. None of this makes the news, but every shipping contract written afterward quietly reflects the change. From there, the pressure spreads. Shipping companies don't absorb these costs indefinitely. They pass them forward to energy firms, manufacturers, retailers, and airlines. Energy markets feel it first. Oil and gas prices don't rise only because of shortages. They rise because of risk premiums, the cost of uncertainty. When transport becomes riskier, future supply becomes harder to price. Traders hedge more aggressively. Volatility increases. That volatility itself becomes a cost. Now zoom out to global supply chains. Modern supply chains are optimized for speed and predictability, not shock absorption. They work well when everything is stable and poorly when risk becomes persistent. As maritime risk hardens into assumptions, firms quietly adapt. They hold more inventory. They sign shorter contracts. They diversify suppliers, even if it's less efficient. They delay investment decisions. Each choice makes sense individually. Collectively, they slow the global economy. This is where the structure becomes political. Governments face a dilemma. If they respond forcefully, they risk escalation, military, economic, or diplomatic. If they respond cautiously, they risk normalization, where higher costs and instability become the new baseline. Alliances complicate this further. Many U.S. allies depend on energy that moves through vulnerable choke points. They also depend on U.S. security guarantees. That puts them in an uncomfortable position. Support aggressive deterrence and risk domestic inflation. Push for restraint and risk appearing weak or unreliable. So they hedge. They stockpile energy. They seek alternative suppliers. They quietly prepare for longer disruptions without openly acknowledging why. Meanwhile, capital moves ahead of politics. Investors don't wait for policy clarity. They price uncertainty immediately. Money shifts toward assets perceived as resilient to instability. Energy producers, defense firms, commodities, hard assets. At the same time, long-term investment in trade-dependent sectors slows, not because the future looks catastrophic, but because it looks uncertain. This matters more than crisis. Crises end. Uncertainty lingers. Now add proxy dynamics into the structure. In gray zone environments, responsibility is intentionally blurred. Actions are small, deniable, and indirect. This ambiguity is not a flaw, it's a feature. Because when no single actor crosses a red line, no one feels obligated to respond decisively. Insurers, however, don't need attribution. They only need risk. That's why proxy activity can have outsized economic impact without triggering military escalation. The structure rewards actors who stay below thresholds while still raising costs for everyone else. Finally, there's the institutional layer inside the United States. Policy responses are filtered through courts, Congress, elections, and public opinion. Each layer slows reaction time. This doesn't mean paralysis, but it does mean friction. And friction is exactly what this system exploits. By the time a response is debated, priced, coordinated, and implemented, markets have already adjusted. That adjustment becomes embedded. What looks like passivity from the outside is often the result of overlapping constraints on the inside. Taken together, these invisible structures form a self-reinforcing system. Risk raises costs. Higher costs limit political options. Limited options encourage ambiguity. Ambiguity sustains risk. No one designed this system in a single room. It emerged from incentives interacting over time. And once it exists, it doesn't need constant escalation to keep working. It only needs uncertainty to persist. That's why this issue isn't loud. It doesn't announce itself. It hums quietly in the background. In contracts, premiums, planning decisions, and delayed investments, until the effects feel obvious, even though the cause still feels distant. Escalation in this system does not begin with sirens or speeches. It begins with a shift in assumptions. Nothing dramatic changes at first. Ships continue to move through contested waters. Energy flows remain uninterrupted. Markets do not panic. From the outside, the system looks calm, but beneath that calm, expectations begin to adjust. Insurers quietly reassess exposure. Contracts are rewritten with slightly more cautious language. Shipping firms add modest surcharges that are framed as temporary. Energy traders widen their risk ranges, not because supply is threatened, but because certainty is. At this early stage, ambiguity actually stabilizes the situation. Governments avoid decisive action in order to prevent escalation. Markets interpret restraint as reassurance. Proxy actors observe that pressure can be applied without consequence, as long as it remains deniable and limited. No one feels responsible for escalation because no one has crossed a clear line. Each actor is simply responding to incentives as they see them. Over time, however, temporary adjustments stop feeling temporary. Insurance clauses remain in place longer than expected. Surcharges do not disappear. What was once a short-term precaution becomes a standard feature of contracts. Companies stop waiting for conditions to normalize and begin planning around instability instead. Shipping routes are adjusted slightly. Delivery times lengthen by days rather than weeks. Inventory buffers grow. These changes are small enough to avoid attention, but large enough to reduce efficiency. This is not a crisis. It is friction. At this point, the pressure begins to spread outward. Energy prices become more volatile even when supply remains adequate. Central banks hesitate to ease policy because inflation no longer behaves predictably. Political leaders face rising frustration from voters who feel costs increasing without understanding why. There is no single event to point to, no clear adversary to confront. The discomfort feels systemic rather than political. Proxy activity becomes more frequent, not because escalation is desired, but because it remains effective. Each incident stays below the threshold that would force retaliation. Each one reinforces caution among insurers and shipping firms. The system learns that uncertainty works. As months pass, costs begin to influence policy choices directly. Governments are no longer debating escalation in abstract strategic terms. They are responding to domestic pressure. Energy subsidies strain budgets. Trade-dependent industries lobby more aggressively. Public tolerance for prolonged uncertainty erodes, even if open conflict remains unpopular. Alliances begin to feel the strain. Countries that share strategic goals discover they have different tolerances for economic pain. Some push for firmer deterrence. Others quietly prioritize stability and price control at home. Coordination weakens, not because of disagreement over objectives, but because of disagreement over acceptable risk. Markets notice this divergence. Volatility increases again. Capital flows toward assets perceived as insulated from global trade friction. Long-term investment slows in sectors dependent on stable logistics and predictable energy costs. Younger workers entering these industries face fewer opportunities, even though demand has not collapsed. At this stage, escalation no longer depends on new events. The system itself is doing the work. Companies begin to make structural adjustments. Supply chains are redesigned with redundancy in mind rather than efficiency. Energy import strategies shift away from lowest cost toward lowest risk. These decisions are rational at the firm level, but collectively, they slow global growth. Friction becomes embedded in the economy. Institutions struggle to adapt. Rules designed for a stable, integrated world are applied to one that is fragmented and cautious. Compliance costs rise. Disputes multiply. Decision-making slows further, reinforcing the very uncertainty that triggered the adjustments in the first place. Proxy activity continues, but its role changes. It no longer needs to escalate to be effective. The baseline level of risk is already high enough. The system has internalized instability. Eventually, the accumulation of strain forces some form of resolution. This does not necessarily mean peace or war. It means change. In some scenarios, resolution arrives through shock. A single incident breaks ambiguity and forces decisive action. Markets react violently, but clarity returns quickly. Costs spike, then settle into a new equilibrium. In other scenarios, resolution comes through reset. A negotiated framework emerges that does not eliminate risk, but restores predictability. Higher baseline costs are accepted in exchange for clearer rules. The system stabilizes at a less efficient but more legible level. In neither case does the system return to where it started. By the time resolution arrives, expectations have already shifted. Contracts reflect higher risk. Investment patterns have changed. Trust has been recalibrated. The cost structure of global trade is permanently altered. What makes this escalation ladder dangerous is not aggression. It is inertia. No actor needs to choose escalation. They only need to delay resolution. In systems governed by insurance, contracts, and risk pricing, delay is often the rational choice. Each step feels prudent. Each decision appears defensive. But together, they move the system upward. That is why this kind of escalation is so difficult to interrupt. There is no single moment to reverse, no dramatic decision to undo. The pressure builds quietly, spreads widely, and hardens slowly. And by the time it becomes obvious, the ladder has already been climbed. Situations like this feel unfamiliar because they rarely announce themselves in dramatic ways. But history offers mirrors, not exact matches, yet patterns that rhyme. In the 1980s, during the Iran-Iraq conflict, global shipping through the Persian Gulf continued even as tankers were attacked. The goal was not decisive victory at sea. It was to raise the cost of commerce. Insurance premiums surged, escorts became necessary, and energy markets priced fear long before supply disappeared. What mattered wasn't how many ships were hit, but how many might be. Earlier still, during repeated disruptions of the Suez Canal, global trade didn't collapse overnight. It bent, routes lengthened, costs accumulated. Political power shifted not because of who controlled territory, but because of who controlled reliability. The economic impact was felt far beyond the region, long after headlines faded. These episodes remind us that choke points do not need to close to reshape the world. They only need to feel uncertain. What makes the present moment different is subtle but important. Today's global economy is faster, more financialized, and far less tolerant of friction. Supply chains are optimized for speed. Capital moves instantly. Risk is priced continuously. In earlier eras, disruption arrived visibly. Ships were sunk. Canals were blocked. Decisions were obvious. Today, disruption arrives statistically, through clauses, through premiums, through probability. That makes modern escalation quieter, but also more persistent. Instead of shocks that force resolution, the system absorbs strain gradually, and gradual strain is harder to mobilize against. Historical analogies are useful because they show that this pattern is not new, but they are imperfect because the mechanisms have changed. The battlefield has shifted from water to spreadsheets, from territory to contracts, from confrontation to calibration. History doesn't tell us what will happen next, but it does tell us something uncomfortable. Systems can drift into prolonged instability, not because leaders choose chaos, but because no one chooses clarity. For most people, this kind of escalation doesn't feel geopolitical. It feels personal. Middle-class households experience it first as background pressure. Energy costs rise unevenly. Grocery bills creep upward. Travel becomes slightly more expensive. Nothing spikes all at once, but budgets feel tighter year after year. Raises fail to keep pace. Planning becomes harder. For retirees, the impact is quieter but sharper. Fixed incomes are sensitive to essentials. Fuel, food, and healthcare costs matter more than market headlines. Investment portfolios may grow in nominal terms, yet purchasing power feels uncertain. Decisions about travel, downsizing, or helping family are delayed, not out of fear, but caution. Small businesses face a different kind of stress. Shipping costs fluctuate. Inputs become less predictable. Margins thin. Owners hesitate to hire or expand. Many small firms rely on stability more than scale, and prolonged uncertainty erodes both confidence and cash flow. For them, resilience often means standing still. Future workers, those under 30, feel the effects indirectly but profoundly. Entry-level wages struggle to keep up with living costs. Career paths become less linear. Temporary work replaces long-term planning. Saving for the future is postponed, even as volatility increases the importance of early investment. Opportunity still exists, but access becomes uneven. What connects all these experiences is not crisis, but compression. Less room to absorb shocks, less margin for error, less confidence that tomorrow will look like yesterday. This is how geopolitical risk becomes social risk, not through headlines, but through lived experience, through decisions deferred, through choices narrowed. And because the cause feels distant, the response often feels isolated. Each household adjusts individually. Each business adapts alone. The pressure spreads quietly without coordination. The most unsettling part of this story is that there is no clear breaking point, no single decision that fixes everything, no dramatic moment when the rules snap back into place. Instead, the rules slowly change while everyone is still playing. Shipping continues, trade flows, markets open each morning. On the surface, the system functions, but underneath, trust is thinner, risk is higher, and resilience is weaker than it appears. This is how instability becomes normal. Not because leaders want it to, not because war is inevitable, but because uncertainty is easier to tolerate than confrontation, for now. The danger isn't that the world stops moving. It's that it keeps moving in a way that costs more, delivers less, and leaves fewer options when something finally goes wrong. When people eventually feel the impact clearly through prices, jobs, savings, it will seem sudden, but it won't be new. It will be the result of choices made quietly, months or years earlier, when the signals were subtle and the incentives pointed toward delay. This is not a prediction, it's a pattern. And patterns matter because they tell us where attention should go before outcomes become obvious. If you want to understand what shapes the future before it reaches the headlines, before it reaches your wallet, this is where you start. Not with slogans, not with certainty, but with systems, incentives, and the quiet places where pressure first appears. Because by the time everyone agrees that something has changed, it already has.